Hello folks, and topic of today's lesson is very important. It will allow you finally to understand how you can engage in price action. Obviously it's not everything about it, but it's the simplest way to find trades frequently every day, guaranteed. Not guaranteed profit, but definitely guaranteed setup. It works on any time frame and it's stupidly simple. So let's get started. So from previous lessons we've learned about classic market structure, and it's gonna be required to understand what I'm gonna teach right now. So today we're gonna learn about zones. When price is moving, we create swings. Yes, and we create a move to create a swing point, and then move down and up. So for bears, we create a move up before a move down. And what do? We mark out this move up and find 50% of it. And when price hits 50% of the opposite range, we simply enter into one-to-one trade. One-to-one risk to reward. Can you increase it? Yes. How? You will learn in future lessons. Stay patient. So, price moved a wave, broke a low with a closure, with a displacement. Now we have a protected high. What do? Mark out 50% again. And price might not hit 50%. So what do you do in such situation? You simply leave the zone. But now flip has occurred. Can you still use the zone to enter short? Yes, you can. But it will be much less probable for it to work out, because now you're trading counter trend, and sometimes price just can explode and your stop will not get respected because of slippage. So I don't recommend trading counter trend, but I will show certain examples when you can do that. So we broke lower and then we moved up and created a flip. And here we found a small zone and a big zone. So opposite ranges. So you might thought that we should target 50% of that. And sometimes it's true, but most of the time you wanna find a zone which is responsible for the break of structure, flip, or just break of the low. So not break of the low, but break of the low. So when we retrace, we can just enter here and still target the high of the original zone, and with that we can increase our risk to reward. So here is a little bit different schematic. The only thing that I want to show that it works not only with zones that are flip zones, but with any zone. It helps to reduce risk, so like that, and increase potential reward. Please understand that these zones are not 100% win rate. If you just gonna apply them mechanical, you need to have certain context and logic behind them. And also just do not trade them counter trend, even if you can. So first case is when we, for example, move down. We create certain formation here, we create a flip, and then we have very strong displacement lower here. And then, so here is a situation when I would have taken a counter trend short. It's when we have a very strong displacement after a first zone that was created after a flip. So we create a flip. This is first zone of flip zone. Then we move up, and then this one, second zone, is usually very high. So the second zone is usually very probable, and you can take short out of it. Also, if you see that price moves very aggressively into that zone, I recommend you to take your limit off. So right now we're gonna talk about zone validation, because obviously there are many zones and few work out. The simplest way to identify highly probable zone that's gonna give you a one-to-one trade is look for fail to close. What do I mean by fail to close? I taught in a previous lesson. So the easiest way to find a valid zones is look for fail to close zones. So the first thing that you wanna look for is a fail to close to occur. So here is a flip zone, don't pay attention to it right now, but here you wanna see a no closure above a high. So it should be a sweep. And then strong displacement lower. Once we come back up, you can enter short, put in a stop about a high of that zone, and target the bottom of that zone. You wanna take it the short only on your demo account, and don't try to repeat it on your live account. Using this model on your personal account is solely your decision, and I will never encourage you or motivate you to trade with your own money. So, why do we have this zone above? Because zones that are left unmitigated can be tapped. So once they get tapped, you're getting stopped, and that's definitely not what you want. So you want to be sure that this zone is mitigated. I personally want to see at least 30% of the zone to get tapped. Like that. To deem it mitigated. But at the beginning, I would recommend you to focus only on 50%. 70 and 30% are not that important. And the concept of zones I've learned from Dave Teaches, even though I'm more ICT trader. I learned about zones from Dave Teaches, and he does not teach 30 and 70% publicly. Everything that I've discovered about 30 and 70% of the zone is solely from my personal experience and backtesting, and the actual way that Dave Teaches trades them is his personal way, so I don't really know the way he trades it. So if you came here to find a way how to trade 70 and 30%, I recommend you to purchase a Dave Teaches mentorship. So now let's get back to the main topic. This is a first way how you can find valid zones. Also, I recommend you to skip flip zones. Why, you may ask? I don't recommend you to use flip zones or like first zones, because you may get trapped on trading day when the price just expanded, created a swing point, created a flip, and then simply continued higher. So this is gonna be a fake flip, and you need to have a higher time frame narrative to avoid that. Also, you can just simply avoid flip zones and don't think much about it. Now I'm gonna explain you when the fake flips occur. Usually, and like most of the time, it's the same thing over and over again. We move up, down, protected lows, and then we break a protected low, so you will think, oh, flip, short. But there are two issues here. First of all, we mitigated an unmitigated zone. If it would have been like that, this would have been a flip. But because this zone was left unmitigated, it can launch the price all the way up. And the second reason is on the left side of your chart. There were probably something that price has to mitigate from the higher time frame, so that's why it ignored this flip. So if you will just avoid taking trades from a flip zones, you don't need to think about all of that at all. But obviously, as you improve as a trader, you got to understand all of that, and eventually you will be able to fade flip zones and trade them when they actually will result into a move down, or just reverse it for bullish, so up. Fake flips occur quite frequently and can trap you many times. So another way to find a valid zone is to look for a zone that has a lot of displacement. So what is displacement? It's a willingness and price to move just from point A to point B. You wanna see this law to get broken with speed and distance. Okay, so you may ask, what is speed and distance? You wanna see gaps to form when we break a law, so here should be an imbalance, a fair value gap. If you don't know what that is, I'm gonna teach you in the next lesson. It's gonna be very short and easy to understand. And also you wanna see a candle. For example, this zone is a sequence of 2 candles. You wanna see the highest candle to get broken in 1 candle. So let me draw it so you will understand it better. So for the sake of clarification, let me draw it so you will understand it much better. So I've drawn a couple candles to show you how it would look on the price action. You wanna see the highest candle, or it could be all of that, a 1 candle to get broken in a single 1 down close candle. So it shouldn't be like 2 candles to break this single candle or more. You wanna see 1 candle to break all of that, and then you can just use a lower wick or just simply tail, and you can enter off of that and target even more than 1-to-1. You can target the low if market structure supports it, and if your bias is bearish and you have a good narrative and economic calendar suggested. By the way, how to use economic calendar we will learn later, but it's not really important. So the break of a single candle I learned from a guy on Twitter with the name AP Trades, and he calls that QS. So we will call that QS formation when we break a single candle with a candle of that's like up close candle with a down close candle, and down close candle with a up close candle. So this is very strong indication. I hope I clarified everything well, because so QS zones can be very explosive, and usually they work very well. So let's get to the next method. So this way of identifying valid zones allows us also to reduce our stop loss, and it's quite similar to fail to close. But you don't need a fail to close zone. You need to find a high for zones that you're gonna take short from. So from bearish zones, or a low inside the bullish zones, and you simply put your limit not at the middle of the zone, but at a high. And once it sweeps a high, it will head lower. You can take partial at the bottom of the zone, and then you can leave a runner and take almost everything out below the low that brought you above. So this method allows us to also reduce our stop loss fast as the price moves away, but be aware that double sweep may occur on like 10 seconds time frame. But as you can see, our risk to reward usually it's gonna be bigger. So this one is gonna be quick. You don't want to use zones that already have been mitigated. Just simple as that. So here, what do we see is I don't recommend you to take zones that were formed inside consolidation, especially before we took some major low. So usually, if we didn't take any higher time frame important low or high, it depends on which side this thing is forming. So here we are looking at as a bearish perspective. This will just end up as power of 3 formation. What is power of 3? I'm gonna teach in the next lessons. But for now, just don't take zones that are inside consolidation, because usually they get run. Now I wanna talk about trading origins of the move. So I think from the name it's obvious that it's a zone that has started a move. In this case, it's this one. When we come back down to the origin of the move, I always want you to wait for a sweep. After sweep has occurred, you can enter into a long position in this current example on your demo account. Origins of the move you can find on lower time frame. So for example, if this 15 minutes, this would have been a 1 minute time frame. If you trade 2 or 1 minute time frames, you can just check out seconds time frame. There is nothing wrong in trading seconds time frames. Is to find lower time frame zones around 50%, preferably above if we're talking about shorts, and below if we're talking about longs of the zone. So if we have this bearish zone, so we are willing to take a short, we can drop down on 1 minute chart and find a little either consolidation or zone inside of this zone, and then we enter off of that zone and put our stop above it, but we target the low of the bigger zone, in which cases you don't want to do that when we have a lot of unmitigated price action above the zone. This may result in a stop out, and in that scenario I would rather take a sweep entry when we have, for example, some like a zone high here, and you just wait for price to trade above it and then move lower, or simply avoid it. So this is our first live example of fail to close zones. As you can see, here we didn't manage to close above that high. We moved away from the zone, and then we retraced right back up to it. Also, we have here a high that gave us a sweep. In this example, we have a QS formation right here. As you can see, we closed below this candle in a one candle. So to close below this candle, it took only one 15-minute candle. We traded right, so we traded right back up to it and moved directly to the bottom of the zone and didn't move any lower. It might have seemed that it didn't work out, but as we know, wicks are moves up and down. So at one point, it moved up and then down. So here we can see that we created this fractal. Basically, I forgot to explain what fractal is. So ICT teaches them as a balanced price ranges. I call them fractal because I've learned them from Dave Teaches FX. They look simple as that. It's just the same zone as this one, but on a lower time frame. So you can see these pockets in the price action. They are actually zones, just on a lower time frame. So why do we need this fractal? Because this fractal is responsible for breaking a low with a closure. So if we will extend it out in time, we can see that it delivered our one-to-one. And also this is a fail to close zone, this bigger one. By the way, this fractal failed because we had unmitigated zone above, and this zone has failed to close, but so this zone also allowed us to take a short from. So here is a short, and this is another one, but I don't recommend you to take a trade when we have unmitigated zone above or below you, below if you're bullish and above if you're bearish. So here we can see an origin of the move. Price created, fail to close, hit an important point in the price action, and that's why I tell you to wait for a sweep to occur if you're trading an origin of the move, because usually it's part of consolidation, And as you can see, here we almost tapped the zone. Usually when this occurs, this is very good signature, because when it will return, it will likely deliver. So we sweep this low. You can enter using a limit, putting it right at that low on your demo account. And as you can see, it delivered pretty well, but I would still target not more than this high. Here you can see very good example why taking counter-trend trades is not really beneficial, because here we have QS formation, fail to close, really good displacement. We even took out this low, but because the narrative is bullish and also no protected lows are getting broken, we ignored this zone and kept moving higher. Instead, we had this QS formation here. This is the entire zone, and you could have taken a trade from here. This is our QS formation zone. We tapped it, and this is a wick, so it means that it moved up, tapped it, moved below, delivered, and then kept on moving higher. But you can see a power of fail to close and QS zones, that it delivered even when we were wrong. So here we can see an example when we have a high around 50% inside of a bearish zone. It increased its probability, and we delivered lower pretty fast. You can see how price didn't show a desire to close above this high. Also, I want to mention that I don't consider that a closure. I would look at the most recent high, and just I wanted to see closure above it. If it would have closed above it with displacement, I would potentially doubted my decision to take a short here. Here we can see the same thing. We closed below. On lower time frame, this is our high. Also, this is an imbalance. If you don't know what imbalance is, don't get upset. I will teach it in the next lesson. But for now, let's select this high. As you can see, we didn't close above it. This doesn't count. And then we move lower. This is another Q zone that delivered perfectly. As you can see, we tapped. Also, if you wanted to refine your risk, you can select this fractal, enter off of it, and exit at the bottom of the zone. So this is the same. So as you can see, this is our fractal, and it's very close to 50%. So this is the same thing as I have explained earlier. It's just a zone that's around 50%. We can just select it. It's responsible for the break of this low. Stop above this fractal and target the bottom of the bigger zone. This is for risk to reward, and you could take this trade on your demo account. I think that's enough for today. That's a lot of information to understand at once. Backtest, look at your own charts, and I hope you will understand it.